there'll be numerous ways in which the returns of private equity have been enhanced by the cheap financing of the last decade, and now simply there's too much capital around.
Welcome back to Breakout from Breakingviews, brought to you by PGIM. I'm Peter Thal Larsen, Global Editor of Breakingviews, and I'm joined this week by Edward Chancellor, who's in New York. Eddie, good morning. Good to have you back.
Nice to see you, Peter.
So Eddie, this week you're taking a typically sweeping look at the private equity industry, a business that has enjoyed incredible growth in the last decade or so. I think you say its assets under management have increased by nearly $10 trillion. And the value of private equity deals topped $1 trillion in 1 year and during the pandemic period. But you think the party is coming to an end. So why?
Well, I point to two factors that might be bringing the party to an end. One is just the increasing cost of finance, and the other is regulation. And let's start with cost of finance. Private equity inception, the buyout business generally, is deemed to have started in 1981 when former US Treasury Secretary Bill Simons bought Gibson greeting cards, made lots of money. And that coincided almost to the month with the beginning of the great bull market in US Treasuries, of falling interest rates, of 4 decades of falling interest rates. And every time private equity buyouts ran into trouble at the end of the 1980s with the RJR Nabisco deal, in the early 2000s, a lot of tech stuff going rotten in the GFC. Every time you had those problems, then easier money and lower interest rates came to the rescue, and never more so than after the global financial crisis, when buyout firms enjoyed the lowest cost of financing in history. And my argument, it's got to be pretty sort of uncontested, I would have thought, is that we're never going to see such ease of financing in the private equity world going forward. But also, one has to think that these bond bear markets, periods of rising interest rates, tend to last decades. So I think that's one junction.
So, but just to drill down on that a little bit, I mean, I guess the private equity people would probably say, but in these periodic crises, when there's been a sell-off or something, that's the time when we have managed to go in and buy things at a bargain and then ridden the wave back up again. And so presumably, given what's happened in markets, given what's happened to share prices and so forth, they must likely be rubbing their hands and saying this is going to be a great time for us.
Yeah, I think that you get more opportunities in down markets. That's a given. Trouble is that private equity has grown so much in recent years that there's now nearly what they call $3.5 trillion worth of dry powder. So that's much more money going after a limited opportunity set. And as I say, in the past, the returns have been goosed with the cost of with access to cheap funding, and not least, for instance, you can have subscription lines of credit, which apparently boost private equity returns, the IRRs, by 3% per annum. So there'll be numerous ways in which the returns of private equity have been enhanced by the cheap financing of the last decade, and now simply there's too much capital around.
Okay, so the money's getting more expensive. What's the other sort of tailwind that's becoming a headwind?
So this is inspired slightly by a polemical new book on private equity by a federal prosecutor called Brendan Ballow with the title Plunder, and he argues that private equity is really what economists would call an extractive industry, that is extracting income, taking from the poor, giving to the rich. It's scary stuff if you were to fall for it. I think a lot of his claims are overblown. However, thinking about it, the regulations at the beginning of the private equity boom were relaxed under the Reagan administration. Pensions were allowed to invest in riskier investments. Capital gains taxes were reduced. So we've had this 40-odd year period of a sort of regulatory tailwind. To my mind, that is now changing. You're aware that the Biden administration have is imposing much tougher rules on looking at mergers at the FTC and the Justice Department. And I think the Balu book will be sort of grist to that mill. So I think that, in short, you've got this 40-year period of falling interest and lax and weak regulation. And it could be that both of those tailwinds turn into headwinds going forward.
Yeah. So, well, I guess maybe the masters of the universe and the private equity firms, now is when they really have to show whether or not they're actually adding value to the companies that they buy, or whether they're just riding the wave. We shall see. Eddie, it's fascinating as always. Thank you very much for your time, and we'll talk to you again very soon.